All right, let's get into the most important part of your trading career. It's this one thing right here. And if you don't have this one thing, trading is entirely pointless if you do not do this one thing right here. If you don't have it in your trading, if you don't execute it, if you turn your head to it, if you betray it, it will stab you in the back, it'll empty your trading account, and it will leave you crying in the corner of the room asking for your mom or your dad. So that being said, it's this thing right here. It's called risk management. Okay. If you don't have risk management in trading, let me give you an example. There's no point in making a winning trade and then another winning trade and then another winning trade only to have one losing trade come and wipe out all of your winners and then wipe out your initial account starting balance and then losing all your money and then leaving you crying in the corner asking for your mom or dad. If you don't control this beast right here, which is called risk, then you're going to end up losing all your money and you're going to be really sad. So that's why it's so important. It's because, like, literally there's no point in making money, right, if you can't retain that money and you can't profit on a consistent basis without ever having any huge losses. Okay. They say something else as well, and I kind of subscribe to this. It says that more traders would be more profitable if during their first year of trading, instead of focusing on making money, they should focus on not losing money. Because whenever you switch your focus to risk assessment, controlling risk, risk management, whenever you shift your focus to that, you end up doing something really unique, which is you're going to take less losers, and then the trades that you do win are going to leave you more profitable. Winning a trade is great, but you can't really control how much you win. You can't predict it. Nobody knows what's going to happen in the markets. It's all based off what you believe is going to happen and then how you execute that belief in the trade with a controlled risk. So let's just jump right into what the definition is. I think that's a great place to start. So risk management in business, it's the forecasting and evaluation of financial risks together with the identification of procedures to avoid or minimize their impact. Okay? So let's just break that down in a super simple thing. If you have this thing right here, which is called risk, this thing right here gets in the way of the things that you want to accomplish. Okay, for example, if this is your end goal right here, which is profitable trading, you start out right here, and what should we do? We'll do you as an X. You start out right here, and to get to profitable trading, you're not just going to be able to click buy or sell on the charts and always profit. You have to go through this beast right here, which is losing trades, managing winning trades, modifying orders, watching the market, seeing what's happening. You got to get around it, and there's no way to just go through this beast. You have to acknowledge that it's there and then do things to trim risk as little and make it have as minimal impact on your trading as possible to get to this thing right here, which is profitable trading. If you ignore this beast called risk right here, you will die trading and your account will be blown and you will be crying over here in the corner. So I don't want you to do that. So that first thing that it said right here is the forecasting and evaluation of financial risks, and you put that together with the identification of procedures to avoid or minimize their impact. So essentially, risk management boils down to you just identifying that this thing is a thing and that you need to control risk in trading somehow. And then you do this procedure right here to get around a lot of risk to control it, okay? Now, I'm not saying you're going to win every trade that you take, and I'm also not saying you're going to lose every trade you take, but what I am saying is that you must control it, okay? And we're going to examine that. So let's get into the second portion of this. We've already gone over what risk management is, and it comes with identifying, like I said, identifying what the risks are and then figuring out how to get around it, like a procedure for dealing with that. And there are a couple ways to do this, okay? So whenever you're trading, let's say that you think that a market is going to go up, and so for some reason you want to buy, okay? We're going to learn all about how to enter trades, like when to buy and sell. You're going to learn all that in the course, but you need to learn this first right here. That's why I'm teaching you this before I'm teaching you how to trade, because the technicals about where to buy and sell, none of that matters if you don't do this right here. So that's why I'm teaching you this in the first place. So let's say you want to buy right here, and you think that right there price is going to bounce, and then it will go up to a higher price, and then you can like take your profits right here, and it will be good. So for instance, let's say this is the price of, I don't know, like a candy bar. And this price right here is $10, and for some reason this candy bar is just being sold out at every store, and there's people that are willing to pay like $15 to $20 for it. And so you get a chance to buy this candy bar at $10, and then price goes up and you want to take your profits here at $20 and sell it to somebody else at 20, you've made like, you know, a 2 times return on your money, like 2x ROI on your money. And that's great. However, what happens whenever instead of price going up, what happens if you buy right here and then price keeps going down? Now you start looking at that and you're like, oh man, I'm kind of worried, like, you know, but maybe it'll come back up. So then it starts going back up, and then you get happy because you think you're right, and you're like, oh, okay, it'll come back. So price has gone down to here, then it starts coming back up, but then it comes down really sharply. Okay, and then it comes like down here to like, maybe let's say that's like $5. And so you've bought something at $10 right here, which is that candy bar. And now the price, for some reason, people are only willing to buy it at $5 and price has gone down. So now you guys start getting stressed out. And let's just add some zeros to these numbers because this is when it gets scary and this is where it gets relevant. If this was $10 you bought the candy bar, what if you bought 10 of those candy bars? That would mean you spent $100 on these chocolate bars trying to sell them. And then now they've essentially lost half of their value, so they're only worth $50 now if you sold them. And then what's even scarier is what if it keeps going down even further to like $25? And then you know what gets even crazier is if we add another zero. Let's say you had bought like 100 candy bars. So you would have had $1,000 worth of candy bars trying to sell them, thinking it would come all the way up here and you'd be able to sell them all for $2,000 and make a 1K profit. But instead of that happening, it went down. So now all your candy bars are only worth $500, and then they keep going down. Now it's worth $250. Whenever we look at charts like these and people getting emotional and people like watching the value of whatever it is they pressed buy on going down, all of this can be avoided if you have a risk management plan. Okay, so if we look at this on the charts when trading, let's say price had come up here and then price had come back here, and then for whatever reason you just think price is going to bounce right there, so you choose to place a buy right there. Well, the first thing you're going to do whenever you take a trade is you're going to figure out where you want your risk assessment to be. Okay, so you're also going to like kind of sort of identify where you want to get out of the trade in profit, should it go into profit at, and we'll get all to that here in a second. But the first things first, you want to identify what your risk is going to be. And you may have learned this in the terminology, it's called stop loss. Stop loss is an area that you can place on the chart before you even enter a trade and during the trade as well. You can enter that trade, you can enter that stop loss onto the chart, and that's going to automatically exit the trade for you at a loss should price go there. And what this does is this stop loss right here, let's say that you buy right there at this price and price starts going up. Whenever you're trading with bigger account balances and you're trading with larger position sizes, you're risking more money and you're making more money, a small movement like this, let's say for instance, that sends you into $200 profit. Okay? Down here, somewhere down here below where you've entered, you're going to want to have an area where it automatically cuts you out of the trade. And I'll show you why. Let's say you go into $200 profit, but then the market comes right back to where you entered. So now the trade is at like, you know, $0 profit, $0 loss. And then it starts going lower right here to like negative $200. And then it comes down even lower down to here and then hits this area called your stop loss. We'll just abbreviate that with an SL. Comes down here to your stop loss. And then let's say that is a negative $300 loss. That area would reflect a negative $300 loss. So then it cuts you out of the trade automatically, closes your trade for you at a minus $300 loss. And then, let's say, for example, what happens after it hits your stop loss? What if price would have kept going downwards? And had you still been in the trade, it'd be like negative 500. And then what's even scarier, which is what'll wipe people out sometimes, is what if from right here, it keeps going even freaking further, and then it's down to like a 1K loss, like a $1,000 loss. That's where it gets freaky, and that's why you have to have this thing right here, which is your preordained, preset risk for every single trade that you take with the price action trading system. This right here is what's going to save you in the long run, because you're not going to win every trade that's given. And since you're not going to become rich off of one trade, what's the sense in becoming poor off of one trade? Meaning you don't want to let one trade wipe out all your profits. So every single time you press buy or sell, you should have this thing right here called stop loss placed. Okay, and you're going to learn all about how to do that, where your stop loss goes, you know, why it's important and stuff on the future videos. But this stop loss right here will prevent crap like this from happening, like losing all this money over and over, all this money. So you can get out for a small loss, whereas if it would have gone up into the profit target here, you know, then it would have made you like $300, for example. And if you're right more than you're wrong, you're going to make money. A simple trading system will do that, as you guys have seen, from however you join Mission FX, from the stuff that I post, from an ad, from the free training, whatever. You've seen that things are very simple with this trading system, so it's easy to duplicate. It's very, I don't want to throw the words like easy around just like candy, but in my opinion, it's just super simple. Like, it's just a couple lines in the chart, and as long as you just do the same thing over and over, and you apply it in the way that I teach, and you follow along with my trades. I mean, dang, I call every single trade I take to you guys for free in the students group chat. Like this one right here in the Nix analysis server. Like, I call every single trade that I take the exact stop loss, exact target, and everything. So as long as you're applying things right, you're gonna win more than you lose, and everything's gonna be okay. But you gotta have this stop loss in place. Okay. So high and low risk trading systems, they really depend on what your appetite for risk is. That's what they call it. They call it appetite for risk. So for instance, some people may start trading with $1,000. I'm going to abbreviate this with 1K. And some people over here may start with like 10K. The person who starts with $1,000 is probably going to be a person who doesn't have a lot of money in the first place. If this is you, that's cool. I have a whole section at the end of the course that talks about this. It's like a 40-minute long video. And it's cool. Like, I go over all the different specifics and like where you're at and determining where you're at financially, and then what your risk assessment should be, whether it's high, medium, low risk, and stuff like that. But let's just say you have only 1K to invest. You may be more comfortable risking 5% of that $1,000 per trade, as opposed to someone over here who, if you're risking 5% of a $10,000 account, you're putting $500 on the line, versus someone who just has 1K, you're only risking $50. And so the person with the 10K starting balance, or like, say for instance 100K, a 5% risk will be $5,000. I mean, you got to really know what you're doing if you're going to be putting $5,000 on the line per trade. Me right now with the 75K account, well, it was started at 75K, it's up to 90K now. I'm just doing 3% risk per trade, and it roughly trims out to be about 2.5% risk, because I put my risk cap around $1,500 to $2,000 risk per trade to make about $1,500 to $2,000 risk per trade. All of that varies slightly, but that's roughly what it is. So for me, 3% is a good risk appetite, because I know I'm going to win roughly 70 to 75% of the trades. And then on the ones that I lose, they're just that small loss. It's the same thing. So this right here, if you're trading with larger funds, you may want to risk, let's say around 2%, for example. 1 to 2% is a good number. And then if you have good trading funds, maybe like 3%, like me sometimes, is like sort of where you want to cap out at, so that way you don't have like one losing streak kill you. Because I mean, with a 2% risk, you can lose 5 trades and you've lost 10% of your account. 10% of 100K, that's $10,000. And whereas if you're over here on 1K and you're risking 5% per trade, if you lose, what is it, like 2 trades, then you're only going to lose like $100. If you lose 4 trades, it's like $200. That may be a lot of money to you, especially if you only have $1,000 to invest. Like I go over at the end of the course, if you only have like 1K to invest, there's ways to like, go about making more money, and there's ways to like mitigate your risk. And what I do recommend is saving up a couple thousand before trading. But let's just say with the smaller amount of funds, if you want to make any significant returns, you're going to have to risk more. And the whole takeaway I wanted to get you to understand right here, it's okay to have a high risk trading system and be risking more, and it's okay to have a low risk trading system and risk less. This is all determined based on what your risk appetite is. So if you're okay with putting $5,000 on the line, risking 5% per trade, this would be like a 5%. If you're okay with putting like $5,000 on the line for every trade, that's cool. I mean, you're going to be making at least $5,000 on your winners as well. And if you're right 75% of the time, then the odds are going to work themselves out. The stats will work themselves out. You're going to be fine. But you have to choose whether or not you want to trade high risk or low risk. Me, I'd say I'm like somewhere in between. I'm like a medium risk trader. I'll do somewhere between like 5% and 1%. Like I said, right now it's about 2.5 to 3% risk per trade. And that seems to work really well for me. And of course, we'll get into a lot more detail later on in the program about that. So I just wanted to break down the pros and cons of each system and help you identify which kind of trader you are. And you're also going to find that whenever you do your demo practice period for 2 months after you complete the program. So I just wanted to introduce this concept to you. You must choose what kind of trader you want to be. You can't just ignore all this and say, I'm not going to be a part of this whole risk management thing. You must choose and decide from the start what you want to do. And of course, you can test, low risk trading, 2% per trade. You can test high risk trading, 5% per trade, or even more. I know some people that do like 7.5 to 10% risk per trade. I even know one guy in Miami who risks 20% per trade. Of course, he doesn't put all his money into one trading account, but he starts an account and he does each trade like a 20% risk per trade because he knows he has a win rate above 70%, and so he knows that the statistics will work themselves out. And so he's able to double his account over the course of a month. Whereas me doing this over here, which is like 2.5 to 3% risk per trade, trading on high funds like 75K, like I can make, roughly about 20% per month. And for me, like 10 to 15, 20% a month, that is insane. That's crazy. That's very, very, very good. So that's how I see it. But you get to decide. So as you go through the course and you learn more about yourself and you start your demo practice period, you can test all this. You can see what works best for you, and you can decide how you want to control your risk, but just understand you must control it in some way. Your profitability will depend on your capital, and it will depend on your willingness to assume risk. So decide all that and test some things out, figure it out. So another thing I want to get into, which is the next portion of this training on risk management, is risk to reward ratios. Okay, and I want to talk to you guys about the dynamics of risk to reward ratios. So what is a risk to reward ratio? A risk to reward ratio pretty much illustrates that if the market is going up right here and then it pulls back and then it goes up, then it pulls back and it starts going up, and then you say, hey, I want to buy right here. Okay, so I'm going to put a horizontal line that shows where you're buying at. Okay, so let's say you buy right there and you decide, all right, since the market's going up, if the market comes down into here, I want to be out of the trade, and that's where my stop loss is. So I'm going to put my stop loss right there so that if the market comes down, it will automatically close me out as at a loss, because if the market comes down here, like it's probably not going to keep on going up like it's been doing. It's probably going to start doing some shit like this where it starts going down. So you want to have your stop loss in little areas like that. Like I said, this is all going to be taught in the course. Don't worry so much about this right now. I'm just using this to illustrate risk. And let's say that this risk, for example, let's say you're trading a 10K account. You're risking, I don't know, 2% per trade. So let's say that is going to stop you out at $200 should the market drop and come to your stop loss. And let's say a reasonable area to place a target would be somewhere up in this area, right? Because if the market's been going up and it's in what's called an uptrend, which you'll learn all about in the course, if the market's going up, the idea is that the market's going to go up and like try to get up here somewhere, right? So it makes sense, it makes logical sense to put a target, maybe somewhere like right here. Whoa, trackpad on my MacBook Pro. So somewhere right here, and we're just going to call this your take profit, the TP. That's what this area is. That means that if the market comes up there, it'll automatically close your trade in profit. It'll book your profits. It'll close the trade, put it in your closed trades history, and this will be a profit of $200. Okay? Now, where risk reward comes in is it's a ratio, and it's a factor of how much you're risking, which is what this area would be right here, versus how much you're winning. So in this example I just gave you, if we're risking $200 to make $200, we have what's called a 1-to-1 risk-reward ratio. Some people put 3 R's for risk-reward ratio. I just put 2, like I just call it risk-reward, 1-to-1 risk-reward, 1-to-1 RR. That's why you'll see me sometimes whenever I call trades. Once you do get into the group chat later, you'll see it'll say like, yeah, this trade has a 1-to-1 RR, 1-to-1.5, 1-to-2 sometimes, but that's what it is. Now, that being said, there is a common what I like to call fallacy in the Forex trading world. And it is that you must have a 1-to-2 or a 1-to-3 risk-reward ratio. Forgive my terrible, super high-quality software drawings here on this computer. A 1-to-2 or a 1-to-3 risk-reward, a common fallacy is that you must have that. Now, what's a fallacy? Let's break this down. Some of you may not fully understand this word. Fallacy means a mistaken belief, especially one based on an unsound argument. Okay? And the reason I chose to use this word is because it's important, because this is what I've seen so much. And I'll break it all down for you. So let's just dive right into it. So a common mistaken belief based on an unsound argument is that you'll be more profitable if you risk only 1 unit of risk to go for 2 units of gain. And then in this case down here, you'd be using 1 unit of risk to go for 3 units of gain. So let's illustrate this on the chart as compared to the markets going up here, and you buy right there, put your stop here, and put your target right here. This would be a 1-to-1 trade, right? We have 1 unit of risk for 1 unit of gain. Let's use another example. So the market's going up right here, it's pulling back, it's going up, comes back here, and for some reason right there you say, you know, I want to buy, so you buy right there, and then you put your stop loss down here, but you put your target up here. So for this 1 unit of risk, we have the potential for, let's just use this for an example, 2 units of gain. I know that's not proportionate, but let's just say for 1 unit of risk, this is 2% gain. This would be equivalent to risking 1% of your trading account to go for a 2% winner. Or it'd be the equivalent of risking, you know, whatever, 2% of your trading account to go for a 4% winner. With a 1-to-2 risk-reward ratio, what you're going to be going for is you're going to be taking 1 unit of risk to go for 2 units of gain. In this example, you're going to be taking 1 unit of risk that you're going to be putting on the line to go for 1 unit of gain. Okay? So the fallacy comes right here. People say that you will be more profitable if you trade this, because this is what we want right here. You know, why would we risk 1 unit of risk to go for 2 units of gain versus this right here? Like, oh, this is bad. People think this is terrible. You know, we shouldn't be doing this. We shouldn't be doing 1-to-1 because it, you know, hurts your trading. You lose the same amount on your losers as you do on your, as you win on your winners. You know, how are you going to stay profitable? And people say if you have a 1-to-2, you only need to be right half the time. And if you're right half the time or more, then you're wildly profitable. Because if you have, for the sake of simplicity, let's say you take 4 trades with a 1-to-2 risk reward and a 50% win rate. Let's say you lose 1% on the first 2 trades, but then on the next 2 trades you come in and you win 2%. So you win +2, +2. So out of these 4 trades with a 50% win rate using a 1-to-2 risk reward, these total that amounts to a -2% loss on all your losers, and your winners amount to a +4% gain. So taking the 2 losers into account, plus taking the 4% winners, that means you've come out on top +2% on your trading account after 4 trades, losing 2 and winning 2. Okay? Now, here's where the fallacy comes in, and this is the second portion of this, especially based on an unsound argument. The thing is, with risk-to-reward ratios like 1-to-2, and 1-to-3. I've been trading Forex for, it's been coming up on 4 years now. It's been about 3.5. I started like right when I turned 21, and I'm about to be 25 now. And from what I've seen, through my personal experience, this is not from any, you know, Harvard financial markets book or anything like that. This is from personal, actual experience and real results. You will statistically lose your trades more on a 1-to-2 and even more on a 1-to-3 as opposed to a 1-to-1 risk-reward ratio. So while the person who looks at the charts, which is what the kind of common belief is that you want to have this right here. That's you know, want to at least have a 1-to-2, 1-to-3, 1-to-4, 1-to-57 risk-to-reward ratio, right? Like you want to enter and have your stop right here, and then you want to have like a 57, like you want to go for 57% gains, risking only 1%. Well, let me tell you, for a fact, you are going to lose more trades doing a 1-to-2 and a 1-to-3 than you are with a 1-to-1. And this is for 2 reasons. A 1-to-1 risk reward, if you're entering the market, you know, right here, and you have a target here and a stop here, one of the things it does is it's quicker to hit your target. The market has to move significantly less to hit a target. Whereas in this example, the market comes up and pulls back and then starts going up. So you take a buy right there, and then you have to put a stop loss here, and then you have to put a target a lot further for a 1-to-2 and even further for 1-to-3. The market, it has to go substantially further, and then sometimes it'll play around and come back, and then it tries to go up again, and sometimes it'll come back even more back to your entry, and then it has to go up again, and then sometimes it'll go hit your target. But this right here, this is only going to happen with a 1-to-2 risk reward roughly 50% of the time. And if you have above a 50% win rate with a 1-to-2, you are a god. And in fact, you're better than me. You're a better trader than me. If you can have a 1-to-2 risk reward and you will never modify the order after you put it in, you'll have your entry, you'll have your stop loss, and you don't do anything like trimming the risk by moving your stop to break even or messing with your targets or closing positions. If you just literally enter every single trade with a 1 to 2 risk reward and you have your targets being hit at least 50% of the time, you're killing it. Honestly, you're doing very, very, very good, and I'm proud of you. However, you're going to win more and you're going to get your profit targets hit more with a 1-to-1 risk reward and a good trading system, a good simple trading system. Because what are the two components of trading? Just like I've taught you guys in the free training, it's simplicity and risk management. Okay? So risk management right here, this is fine. You're controlling risk as long as you do have a stop loss for trades like this with a preset risk percentage while you're trading price action, which is the system I'm teaching you. It's just basically, price bounces around on lines on the chart. It's that simple. If you have good risk management, the only other thing you need is just a simple trading system. Very simple trading system, which is what you're going to learn here in the program. You're going to learn all about it. Simplicity with risk management equals profitability. It is that simple. I promise you it's that simple. I've done it firsthand. I've taught people firsthand. I have a bunch of students getting crazy results, making thousands of dollars a week. I know what I'm talking about when it comes to this, and I promise you all it really boils down to. You can make it as complicated as you want. You can have all these crazy trading styles, crazy ways of trimming and controlling risk, but as long as you have simplicity and risk management, you can be profitable. That's all you need. And there's no need to do any more than that. And how this all relates into what I'm teaching is that I want you to understand and take this away from me going over risk to reward ratios. You will be more profitable and more effective as a trader if you have a 1-to-1 risk reward ratio using a simple trading system versus a 1-to-2 and 1-to-3 risk reward ratio with the same trading system. What I've worked it out to be is that a 1-to-3 risk reward ratio will win anywhere from 26 to 33% of the time. And I've tested this with 2 months of trading history. And on this right here with a 1-to-2 risk reward ratio, you're going to be winning anywhere between 44 to 53% of the time. This is over 2 months of trading history. This is a mean, and then I had an average number which was right in the middle, but I tracked all my results to see like which one worked out best. And this is without modifying the stop loss and targets or anything. Whereas trading with this one right here, on the low end, what I worked it out to be was anywhere from 62 to 70%, and what I put was 66% is the average win rate with this. And this is under worst case scenarios. My actual win rate is probably closer to like 70. It's probably closer to 70, sometimes even 75. It really just depends on the week. But 66% is really what it boils down to. It's within this range, so that's the range. And then there's like standard deviations and all this crap. But the mean average is with a 1-to-1. If you have this 1-to-1 risk reward ratio with a simple trading system, which is just as simple as like buying when the market's going up, selling when the market's going down with preset risk parameters, you're going to win roughly, let's just say 60 to 70% of the time. And that's fine. All you got to do is win more than 50% of the time. And if you're spending, an hour or two a day on the charts and you know your trading system and you've studied this stuff and back tested it and practiced it on a demo account for 2 to 3 months and you've done all this testing and stuff, you're going to be able to get at least a 50% win rate, if not higher, like 60 or 70. And once you have a 60 to 70% win rate, you can start doing really interesting things, which is like upping your risk to be around, if you want to be like that way and you want to do 5% risk to grow a small account, you can start, risking $50 per trade on a $1,000 account. And you'll have, a winner, and then a loser, and a loser, and then a winner, and then a loser, and then a winner, and then a winner. And as long as you have a little bit more winners than you are losers, you're going to be wildly profitable because you can scale that. You can easily scale that if you already know your stats and you already know what your risk is and you already know that you have this win rate right here over the course of statistical data that you've tested. It's going to be easier, it's going to be less stressful, and you're going to be more profitable if you do it that way. So I've just given you a case study and I've talked to you on the dynamics of risk to reward ratios. And if I'm just giving you personal advice, I want you to know that a 1-to-1, while 1-to-2 and 1-to-3 is fine. I've been profitable for 2 years trading 1-to-2 and 1-to-3 risk reward ratios. You have your targets hit significantly less. Significantly less. And then you also have to do weird stuff such as modifying the orders, moving your stop loss to break even once it goes into profit, and the market comes back and then comes back to your entry. So a trade that was up like 5% $500, then comes back, and then now it's up only $0, and then it starts going negative, and it's like negative $100, and then it goes back into profit and plays around. It's so much quicker and easier with a one-to-one, because you're generally going to see that in a shorter period of time, you're going to have your targets hit. Okay, so a couple of these pros is that this one right here, the one-to-one, it's more efficient, it's less time consuming, you have shorter trade durations. Some of these trades will even happen over the course of a day or two, and it's less stressful. Your profit targets will generally hit more. So the verdict of all of this is that, in my opinion, a one-to-one seems to work most effective for most people, all things taken into account. Okay? So that's what I wanted to cover with you about risk to reward ratios. I don't want you feeling like you're doing something wrong if you're using a 1-to-5 risk reward ratio or a 1-to-1 risk reward ratio. That's something that you're going to be able to test throughout the course of, trading on a demo account and practicing after you complete this course. That's going to be something that you can ask me in a one-on-one call once you complete this course. And so with all that being said, I think 1-to-1 is fine. If you want to be a 1-to-2 or 1-to-3 type of person, you want to test that, then go for it. Test it and track it and see what seems to work the best for you, and then just do what works best for you most consistently. So that being said, one of the last things I want to go over is how controlling risk makes you more peaceful. So remember that first example I gave you about the person who bought, the chocolate bars right here, wanting to sell them all to his friends, and he bought them all for $10 and maybe about 100 chocolate bars, so he spent $1,000 on these freaking chocolate bars. But then all of a sudden, the price didn't go up like he thought they would. Instead, the chocolate factory started just releasing thousands of chocolate bars that same day, and so they're no longer worth $10, and they actually went down. People were selling them for $5, and then even lower for $2, and then people are just trying to get rid of them, selling them for $1. And so the person who put $1,000 into buying all these freaking chocolate bars now has only $100 worth of chocolate bars left. So they've lost 90% of their money. Well, had this same person made a decision to say, you know what, I'm going to try to sell these chocolate bars at $20, and I'm going to make $1,000 profit on these because, I have $1,000 worth of chocolate bars here. If I sell them all at $10 more per bar, it's going to make $2,000 total, or a 1K profit. If that same person would have said, you know what, if price comes down to here to $7 per bar, I'm just going to sell them all to whoever will buy them at $7. I'm just going to sell all my chocolate bars, and I'm just going to get out with only, a $300 loss. Because, if they're dropping and it's not what I thought it would do, then I'm just going to, that's my risk. So that way, in case it does some shit like that and just keeps falling and it goes all the way down to zero or something crazy like that, you don't lose all your money. It's all controlled. And the same thing right here, if it goes up, you could have made, an extra $1,000, or you could sell them all at $13 per bar, somewhere in here. You could sell them all at $60 a bar, whatever. So that being said, the thing I want you to take away is that controlling risk makes you a lot more peaceful, because you don't have to worry about this shit right here. If you're controlling risk, trading is very simple. The market's going up and it's going down and it's going up and it's going down and it's going up and it's going down. And then if you choose to buy right here for some reason, the market goes up, and you know what's going to happen if you enter right here? The market's going to do one of two things. You're going to have a stop loss right here and a target maybe somewhere right there. It's either going to go up to your target or it's going to go down to your stop loss. You're either going to lose money or you're going to make money, or maybe for some reason if the market just goes sideways. I talk about how to manage trades in the course. If it goes sideways right by your entry, well, then you can choose to close the trade right there and make no profit and also have no loss. So that's what we call break even on a trade. So, however, that being said, essentially the market's just going to go up or down at the end of the day, right? Even if it goes sideways for a while, it will eventually either go down or it will go up. You will either make money or you will lose money. And your only goal is to just control these losers right here so that you don't have that long, stressful, oh my God, where do I close my trade at? I've lost 100, now 300, now 500. You never want to be in that position. Cap your risk with a stop loss. And you're going to learn exactly, like I said in the course, where these stop losses go, the logic behind them, exactly how to do it all in the course. But control risk, it will make you a lot more peaceful. And the last thing I want to leave you with is something that I said earlier in this video. It was actually at the very beginning, but I want to leave you with this because I want you to know that this is something that you should stay focused on going forward. And the takeaway of this whole video is that your focus in trading should not be making money. but instead the focus should be weighted towards not losing money. If you focus on not losing money, that will make you more profitable of a trader, and it will make things more easy for you as a trader, as opposed to being the person who's trying to always chase a buck. That means like chase a dollar. For people, for those of you who aren't from the United States, like people who are always trying to make money. Like you never want to be that person who's trying to always make money but never focusing on the losers. So that being said, focus on not losing money. Focus on controlling that risk well. And as long as you do that, you're going to be a lot more profitable in the long run. So that being said, I'm going to get off now, and I'm going to go along to make these next videos. And I hope you guys learned a lot in this video. This video is really important. So if you ever find yourself having losing streaks or getting all wild and crazy, and you feel like you're not getting it, come back and watch this video and make sure that you're doing everything that I've taught you in this video right now. Because in my opinion, risk management is half of trading. The other half is learning like the technical skills, such as like drawing these freaking lines on the chart and seeing where price bounces on these lines and stuff like that. And that technical side, that's relatively easy in my opinion. Like I said, I have a hard time throwing out words like easy and stuff, but it's just so simple. It's literally just cut, like here on my chart, it's just a couple lines. Like in this case, there was like 1, 2, 3 lines I was looking at for this trade right here. Very simple stuff. And so you learn all that in the course. But like I said, risk management is half the game. The other half of the game is like technical analysis, which is drawing up your charts, drawing up the levels, and then managing those trades. And then a lot of people say that emotions come into trading as well. But I will say this, if you have a simple trading system and good risk management, which is that little formula I gave you right here, a simple trading system with good risk management, that just equals profitability. The only reason people get screwed up The only reason people get screwed up with this thing called emotions is because they're losing money, or they're not profitable, obviously, so that causes a lot of emotional issues like, what am I doing wrong? I've been trying to do this stupid Forex thing for a couple months and I'm not making any money, and I keep losing trades, and I'm getting all wild and I'm all over the place. Well, the second you start getting emotional, it's probably because you're not keeping things simple and you're not having risk management. Because if you had risk management prevents you from having any huge losses, so you're never worried about losing your whole account. And if you keep things simple, you're not going to be confused. You're not going to get so emotional and be worried about, well, what am I supposed to do? I'm drawing like a million different things on my chart, and I don't know which way it's going, and I'm just frustrated and I'm mad, and I've lost the last 3 trades in a row. If you're keeping things simple, trading is going to be very peaceful for you. The same way, combine that with good risk management, trading, like this P right here, stands for being profitable, but at the same time it also kind of stands for being peaceful when you think about it. Trading does not have to be hard. It can be very, very, very easy if you keep things simple and control risk. So that being said, you wouldn't really have to worry about emotions if you're keeping things simple and controlling risk. And like I said, do not focus on the money whenever you start trading. Don't focus on making money. Focus on not losing money. Focus on protecting your capital. Focus on controlling risk and taking low-risk trading opportunities that make the most sense to you. You're going to learn all about that right now, actually. So welcome. You're actually able to start the real part of the course that really dives into like market structure, where to enter trades, all of that stuff right now. So I'm excited. You get to go do that right now. I'm done. So I'll see you guys in that section. Bye.